Hi there. Very good morning and good afternoon to all of you, depending on wherever you're watching me. This is Simply Stocks, and I'm live in this live session with you all on YouTube as promised around 2 p.m. So today I want to discuss, and as you would have seen in you can see in the heading, I would like to discuss that why I keep away from most of the sectors, not only infrastructure, banking, financials, etc. But I normally stay away from most of the sectors and only a particular set of stocks that I keep talking about on Patreon, on YouTube. I keep bringing to you all. And what is the reason behind it, rationale behind it, and why do I keep away from the other sectors? I'll describe that and will answer your queries as well. So, welcome all to this session. I hope more people join in. As far as the markets are concerned, I still believe that there could be another round of selling in the mid and small cap, but that would be it. And from mid September onwards, most probably from 10th, 12th September onwards, we will see a run in most of the mid and small caps stocks which are relatively good, which are you can say sound fundamentally, etc. uh, and these kind of corrections are extremely necessary for the market to survive and do well from a long term point of view. And these corrections help the market probably take some rest in a raging bull market. So I think this will continue at least till the end of 2023. Yes, there are issues with the Fed rate hike. There are issues with, you can say, whatever the Fed might do with whatever the economic status globally is happening with the pandemic. Things could get bad again in October, November. There are repercussions for that. But overall speaking, I still believe that on a 6 to 8 months time frame, even in that time frame, a medium term time frame of 6, 8, 9 months, I think we could be headed much higher than what we are at the current levels. Uh, uh, what we are at the current levels in the mid and small cap market. So in my opinion, these declines should be used to accumulate the stocks. If people do not have the money to buy more on these dips, they can just stay put with their holdings if they are confident about the fundamentals of the companies. The recovery should take place from mid of September, and by December, January, you will see the stocks much higher than what they are currently trading at. And I'm talking of all across the board, not only in the consumption basket or consumer centric stocks, but in pharmaceuticals, IT, infrastructure, capital goods. Uh, Relatively speaking, the markets would be higher, say 4 to 6 months from now, than where we are. And I'm talking of the broader markets per se. All right. So now coming to my point as to what I wanted to discuss, and I hope more people join in. And if you're not getting the, you can say feed, and if you're not getting the invitation for live session, etc., do let me know. There could be a situation in which the YouTube is not sending the notification straight away. That could be a reason. Also, do subscribe to my channel. I see that the subscription rate has gone abysmally low. It has gone to about 300 people per month. So that's around 5 to 10 people per day. So that is why I'm bringing to your notice that if you are watching this and you're not subscribed to the channel, kindly do subscribe and hit the bell icon, so that will help you. Also, if you want daily discussion on stocks, on markets, on positioning, etc., you can definitely be a $10 member on Patreon, and then probably send me questions there, and I'll answer each and every question. And I do that for all the patrons that are there. I would like to thank all the patrons for being a member there and supporting me. That has helped me a great deal for continuing with this endeavor, for finding out the best of the stocks, and finding out the best of the answers for your queries in the stock market and investments, etc. All right, now the point here is why I do not talk about stocks which are basically GDP or economy related. So that is what I do. Why I do not do that, and probably my stance will change if things change on the ground. But at the moment, what I feel is that no matter if the pandemic go away and we are back to 2018-19 levels, uh, we have seen a seminal decline in the GDP and Indian growth rate and the growth story from January of 2018. So if you go back before the pandemic, what were we talking about? We were talking of a GDP growth of around 4 to 5% at that point of time, barely 5%. It was normally around 4.4, 4.5% or so. And in that kind of a scenario, suppose those kind of days come back and we have completely opened up, the pandemic go away, inshallah, it should go away in a year or about 15, 16 months at most. We will have a situation in which we'll go back probably to that 4.5% growth again before probably going further ahead, until we grow at around 7 to 8% annually. I do not see economy related stocks really doing well over a longer period of time. Yes, they could do well for 2 months and then the stocks may fall again and all that. But I look for opportunities which could grow your wealth, not just make you some thousand rupees there or some few thousands there and some 20-30% here and there. I look for opportunities which could be huge over 4, 5, 6, 8 years and could continuously go up. And we should not be worried about the market movement. We should not be worried about what the economy is doing. These companies or these sort of companies which I have presented on YouTube, which I have presented more on Patreon, and I've talked about, I have a portfolio and in which all companies are consumer centric. If you look at the reason for that is these companies keep on churning out at least some growth, if not 30%, maybe 15%, maybe 10%, maybe sometimes 30, 40, 50%. In some of the stocks that I'm holding, the growth is 70 to 80% even. So yes, stocks would be expensive on a PE wise, they would be expensive. But what I look for is sustainable growth over a period of time with less effect, as lesser effect as possible of external factors. So, what are the external factors? External factors are the macroeconomic factors. And when you talk about macroeconomic factors, then we look at the GDP growth rate, we look at interest rates, we look at how is the income of the people, or is it growing or not. We look at the job data and everything. We look at how much investments private sector or public sector is doing, the government is doing. And if that is not happening, those companies will keep on moving in a trading range. So a stock per se, say a stock A, I don't want to name one stock, but stock A in the infrastructure space may do very well for 3 months because of some announcement. So it could go from 40 to 60, but would again come back to 14 in a few months' time if they are not executed on time, and then the numbers are not there. A second reason why I don't get into such stocks like banking, financials, NBFCs, infrastructure, capital goods, real estate, even some autos, apart from few auto companies, even some of the auto companies, ancillary companies, all the ancillary companies which are related to all these infrastructure, real estate, banking, etc., whatever I thought said. The second reason why I don't do that is because of debt. It's a simple factor, because no matter how good a company is, if they have debt, and all these kind of sectors have debt, then there will be issues. There will always be issues. There will always be a sword hanging for the companies if the interest rates go up, if the inflation go up and interest rates cannot come down, if something or the other announced by the government which affects the you can say final sales of the company. And also now the third reason, so this is debt, and debt is huge for some of the infrastructure companies. That is relatively high for even very good infrastructure real estate companies. You pick up with the top real estate companies, three, four I have talked about, there is debt. And when you compare them with debt free companies, whether in pharmaceuticals, whether in IT, whether in consumer, these are the three sectors in which you will find debt free companies. When you compare, there is no comparison whatsoever. And once there is no debt, then what happens is even a little bit of increase in sales and ends up on the bottom line, and you get very good EPS growth, very good profit growth. And that is what is the essence of, you can say, finding the best of the companies. No matter what people talk about, that this is a story that could play out, this is a story that could do extremely well, this is a company that are in losses, that's why the stock is down, but will come back into profit, sales will grow, this and that. What does market like? You can write down, you can just pause the video here and write down what is that one thing that the market likes. uh, the one thing that the market likes is continuous profit growth, and that growth rate to continue grow further. So what does that mean? That if a company A is growing at 20% for the last 3 years, then it should grow at 23 or 24% for the next 4 years. That is what the company is liking, no matter what is happening. If they are bringing up those numbers and legally and doing well on the ground, yes, of course, sales will also grow, and only then profits could grow on a sustainable basis. So if that is being happening, there's nothing like it. And the hindrance in that are extraordinaries, hindrance in that is complicated businesses, hindrance in that are you can say debt, or you can say some exceptional items, this and that, a number of subsidiaries, and this and many other things. So this is where I come to my third point. The third point is I look at simpler businesses, and that's why I don't get into banks. That's why I don't get into NBFCs. What I look at is into simpler businesses in which I can understand and at least in some manner find out as to what could be the numbers when things open up completely, when things normalize, or probably two quarters down the line, what could be the numbers. If you are able to gauge that, you're able to gauge where the stock could be headed. There's no way to understand as to where the head would be in a year's time, 2 years. No, nobody can say with certainty. But with simpler businesses, it is more easier to understand than a banking, financial, infrastructure, real estate, or such ancillary companies. So this was the third reason, basically, of not investing. And the fourth reason of not getting into such kind of stocks and completely avoiding that, although I do look at charts, I do trade in them. Patreon members know about it, that some of the real estate companies I have traded, some of the auto ancillary companies I have traded earlier, even infrastructure companies I have liked and talked about. But why do I do not buy as a portfolio, as a long term 3 4 5 years bets? The reason is, the fourth reason is the gestation period. In a cash rich business which deals in cash, say a Britannia, an HUL, a Nestle, an Asian Paints, a Bata, a Godrej Industries, any Godrej Group consumer stocks, you name it, anything. I'm not talking of which could be the best or worst, but these companies have, or Colgate, or these companies, such companies, they have cash on the books, they have cash with them, they have no debt, and yes, they could perform badly or relatively badly than what they have done earlier for a few quarters, but they could do extremely well in very difficult circumstances where other companies with high debt, or with higher gestation period, greater gestation period, might not be able to do. So in that regard, these companies will just sell their products, the sales will generate, you can say, income for them, and the income will generate after taxes and everything, the profit after tax, and that would come in. So the EPS growth will always be there. And one very important point in here is that when inflation kicks in, then these kind of companies earn even more. Yes, they do. So if there is an inflation of 8% and they increase their prices by 10%, then this 2% or 200%, 200 basis point jump is where the profits really rake in. And people do not understand that. Consumers do not uh, care that much compared to other kind of rises that are happening, or inflation that is happening in, say, healthcare or education. So consumer prices for products, if they are increased by 25% more than what they ought to, so what, just try to understand, if the company, because of the inflation and all the raw material prices and everything, has to increase the prices by 8%, and they do it by 10%, so that is a 25% increase of the inflationary increase that the company had to do. And that is where the real profits come in, and that is where you really make the money in companies like Nestle's of the world and the larger ones. And you can look at even mid cap consumer centric companies. I'm not saying particularly FMCG company, I'm saying consumer centric companies where the money is really made big time. And that's why these companies come out with very decent numbers even in higher inflation time frame. So this is where you're guarded completely from lower GDP growth, from lower, you can say, government initiatives into infrastructure, into spending, from lower initiative from private spending, from lower initiative from people, whether jobs are large or small, or there's greater number of jobs for people or lesser number of jobs for people. If they have kids at home, they will definitely or most of the people will definitely look to consume any kind of Nestle product. So we have to look at in such a manner when we are talking of understanding as to where we should invest. So that's why I keep away from these. And as I explained, it is extremely difficult to understand the numbers of these companies into all these sectors that I talked about, that I try to avoid. And it is easier to understand the numbers of a consumer centric company. So these are the reasons why I avoid these sort of companies. So that's what I wanted to discuss with you. I would love to hear your comment, read your comment, whatever comments you have on this. So now we come to probably answering your queries. Kindly use the super chat and super sticker feature that will help me grow the channel and help you also ask me questions and eke out answers in greater detail. So you can use the super chat feature as well. Shankar here asked is, are you, sir, averse to good financial services sector, software stocks like Oracle, Intellect? I am not averse to these IT companies. Oracle is a very good company that you can invest into. But I am looking at new gen tech companies which are into mobile technology, which are into AIs, which are into education technology. And there are many that you can look at. I believe that those companies will grow faster than the others. Okay. Nikhil asks about SHIL and Frontier. So a disclaimer, I have both in my portfolio. I am looking at FY23 in them. I'm not even looking at the numbers at the moment. The numbers were fine, not very great in SHIL, but fine. In Frontier Springs, the numbers were very good, very satisfying. But you need to understand that these stocks will perform in one go. These are smaller companies, especially something like Frontier Springs, 100 crore market cap company. That will perform like a Kilpis did, or a Tanla did, or Dixon did when it was small, or many other, you can say, smaller gas companies, Gujarat Gas, etc. 4 years back, whatever the market cap was and whatever today. So these companies will perform. I'm confident. But when that is a $1 million question. I'm waiting for FY23 to end, and that's when I will be worried if the company has not performed by then. So let's wait 1.5 years for these companies and give them that time frame for these companies to perform. Like granules, I would prefer larger pharma companies, and in fact, I would avoid pharmaceutical for the time being, except for few. There are few companies that are good, but larger context I would avoid because there are issues that are cropping up. FL is a good buy above 4,300 if it goes there. If it is not going there, don't look at it at the moment that the fall has been excruciating. So wait for a recovery. A DMart entry level, I would say around 3,300, 3,200. If it comes there around 3,200, I think 3,000 is a very good support. So that's where you could be looking at. Hi, Manish. Thanks for your super chat contribution. Nothing much. Just want to thank you for the great work you are doing in terms of sharing insights and ideas with us. Thanks a lot, Manish. And these are supports from you, subscribers, and the ones on Patreon. That is helping me. And thank you for your contribution. All right. Harsha added Kilpes at 550. Is it safe for long term? I would say yes. I have a bias, so I'm invested in that, but I'm confident it will be a 2,000 crore market cap company over the next 3 to 5 years. If you have that time frame, hold. If you have less than 3 year time frame, anything can happen. This could go to 450 even. If there is some money left with you, if you can save some money, buy at 450, 430. Those will be very, very good levels to probably get into. Yeah. Dixon at current levels looks extremely attractive. I'm still confident in a year's time, somewhere in the next 12 months, maybe 6 months, 8 months, 4 months, I don't know, 9 months, we will see the stock at 6,000. I'm confident on Dixon. Yes, the fall has been bad, and those who have bought at 45, 4600 might be wondering, but I still believe 6000 is possible on Dixon in the next 1 year, somewhere in that 1 year time frame. Devyani stock is good. So again, these kind of stocks like that Devyani Foods, or you have it the Jubilant Food Works, in that regard Zomato and so on and so forth. They are good companies, but the valuations are extremely stretched, and that's why I don't talk about them, because the valuations are so stretched that I fear even talking about them. That the company is good, but something like a Zomato trading at 90 95,000 crore market cap, uh, I mean that's just insane. 30 35 times sales. So why not probably an IRCTC, which is probably will come out with 60 to 70 rupees of EPS once things open up. Is that 2600? Again, a disclaimer, I'm invested in the stock, but that is trading at 30 times earnings. And in a Zomato, even in Devyani, there is profit, but very less. You have very less EPS. So there, I see it's they are very good concept stocks, but I won't look to buy into all these companies. Newgen software is good around 500 480 if it comes there. Very good levels to buy, slightly expensive. That's what I will say. If you have it, hold. If you don't have it, wait for declines to buy. Advanced enzymes, very positive. No sale, I'm not that sure. But advanced enzymes at these levels look extremely attractive. All right. Very positive, Jeevan, on Blue Star and Whirlpool both. It is just that this pandemic has taken a toll on these kind of white good companies, especially companies which are more related to summers, because we have seen what happened with 2020 summer and 2021 summer. So you need to just be patient with them. If you have not bought, these are very, very interesting levels to buy. I mean, if things really get going, you won't see a Whirlpool below 2000. So that's my call. It has been consolidating for months, so very interesting levels. Acresil is attractive at 620. Tata Consumer is headed to 1000 in a few months time. Acresil is also headed to 1000 in probably a year's time. I think Acresil is interestingly placed. I'm not saying cheap, but it's not very expensive as it was earlier. So yes, you can start accumulating at these levels. Positive, Sudeep, on Nureka from a 3 4 year time frame. From 1 year time frame, we could see some decline in Nureka, but I'm very positive on the company as a whole. I think it could do wonders over the next 5 years. Yeah. Happiest Minds, any declines to 1350, 1360 is a buying opportunity. Technically speaking, fundamentally, it is stretched, but you won't bet against Happiest coming out with 25 30% profit growth, and that will be phenomenal again, considering the IT industry. And with the kind of, you can say, with the kind of you can say orders that are coming to larger companies also, and the kind of you can say positivity with respect to the IT industry that we are seeing from NASCOM, from everyone, I think Happiest Minds has much better days ahead in the next 2 to 3 years. So that's my call. Birla Soft positive. I think 380 to 400 very good levels to buy even at current levels. I think it has potential to give you 30 40% over the next 1 year. 30% very much possible in it. I won't say the same with Cient, but Birla Soft I'm positive on the stocks. Garware Fiber is a good 5 7 year play even from these levels, but it's not a 6 months to 1 year play. I think, see, you need to be rational about it. These stocks have run up so much that they require some months of consolidation. That is what we are going through. So in no way I'm saying that you go ahead and buy these companies and expect a big return over the next 4 months. It could happen. It could very well happen. But what it seems is that next 2 to 3 years you'll make money. Now the when will the reversal, the big reversal would come in? We don't know. Maybe after 2 months, 3 months, or something like that. So musical, I've talked about Happiest Minds. You can reverse the tape and probably have a look. Jubilant and Grovia, I don't have a call at the moment. I need to analyze the company in detail and then tell you about it. Sequent, I have a feeling that could head towards 210, 215. I think 200, 210 would be very, very good levels to add. I think the selling has been a lot. I don't think that its level is around 220, 230. See, you need to understand numbers were not great, and I don't see that the next quarter numbers would be that great. Again, I'm invested in the stock, but over the next 3 to 4 years, I see the stock at 1,000 levels. And I'm not mincing words here. I see it at 850, 900 in the next 3 to 4 years on sequent. That doesn't mean you go ahead and buy now. Probably what you do is, and my honest opinion I've always given, is that wait for the September quarter numbers. Let's see how they end up being, because I am not confident of the September quarter numbers. So that you could see the stock 10-15% down from here even. A VIP again positive. The stock has run up, it has declined again. I think good levels to buy would be between 360 to 400 if you get it. Good levels. I think 3 to 4 years you will see the stock much higher from here. A very good opening up trade would be something like a VIP. All right, guys. Thank you. Thanks a lot for being online. I hope I have answered many of the questions. Would be online on Sunday to discuss about another investment topic, a very interesting topic. So we'll be again online on Sunday around 2 p.m. or so. Thank you. And kindly do subscribe to my channel and hit the bell icon and support me on Patreon. Thanks a lot.